Should presidents have the power to control interest rates, to lower them when they think it's best? That's what we're going to discuss today. It's a pretty important topic because it's, I think, going to be the big topic of the day. So I'm Mitch Goldberg with the wealth management firm Client First Strategy. I'm a financial advisor here. Let's get into this topic and you could decide for yourself, but I think I'm going to give you the background education to make up your own mind about whether or not presidents should be able to raise or lower interest rates. Here we go. All right, everybody, welcome to the pod. I'm Mitch Goldberg, your host, financial advisor with the wealth management firm Client First Strategy, planning, investing, and it goes on and on and on. And we're in it for the long term with our clients. So if you need anything with regard to planning and investing, you know who to call. We are ready to help you. So let's talk about this. Are president or should the president of the United States have the power to control interest rates? Now, I bring this up because okay, let me start again. I bring this up because President Trump was on the campaign trail about saying that he believes presidents should have a say in interest rates. Now, we all have a say in interest rates because we all have an opinion. But does he mean he should have a say, or should he have a say, but we all have to agree with it? I have my say. I disagree with that, what the Fed's doing. Okay, so let me give you some background how interest rates work in the United States. There are two basic kinds of interest rates. I'm not talking mortgage or loans or bonds, etc. I'm talking about very basic terms, two kinds of rates. There are the rates for our purposes that are controlled by the Federal Reserve. That's the central bank of the United States. And it has a lot of other jobs to do, a lot of things to fulfill, especially market regulation, bank regulation, that sort of thing. So the Fed has its thumb on short-term interest rates, the federal funds rate and the discount rate. Now, the discount rate is something that the Fed controls. The federal funds rate, believe it or not, is really more a function of markets, but the Fed has a great deal of influence over that. But for our purposes, let's just say the Fed controls short-term rates like the Fed funds rate. And that's what you hear about. When you hear that the Fed raised or lowered interest rates, what you're hearing about is the federal funds rate. And the federal funds rate is the interest that banks charge to other banks for overnight loans. Banks are always either in a position at the end of the day of excess capital or a little bit of short on capital, so they could borrow from other banks overnight. And they pay, right now, the running rate is about 4.5%. Not 4.5% a night, it's an annualized rate. So let's say 4.5% divided daily, it's a very low, tiny fraction of a percent. But the lower you make it, it makes it cheaper. It makes it cheaper for banks to operate. The discount rate is what it costs banks to borrow directly from the Federal Reserve. Banks don't really want to go the discount route, the discount desk to the Fed. Could mean that there's maybe problems, so they prefer to stick in the federal funds rates in that market. But that's we digress. But the Fed funds rate is what you hear about when the Fed lowers rates by a quarter point. And people think that, well, if the Fed's cutting rates, shouldn't mortgage rates be going down? But they've been going up since the Fed's cut rates. So people are trying to figure out what's the disconnect. There really is not a disconnect. The Federal Reserve typically has never been able to control long-term interest rates. So what are long-term interest rates? I said there's two kinds of rates. The short-term rates that the Fed gets to control, and then there's the long-term interest rates that investors, people like us, get to control. And those are completely different. The Fed does not really have control over long-term rates. It doesn't have control over mortgage rates or most borrowing rates. And you know, the way the bond market works, which is what determines interest rates, treasury bonds pay interest. And right now, the 10-year treasury bonds paying about a little over 4.5% yield. Whether if it's 4.5, 5, or 6%, for our purposes, it doesn't matter. It's just that investors decide if interest rates should be higher or if inflation is higher or could go higher, then investors will only buy bonds if they pay higher yields, and they could sell bonds that pay lower yields because now those bonds are not competitive with the new bonds coming out. So that's how interest rates are controlled, long-term rates. And things like mortgage rates are tied to the 10-year treasury. And business loans, so many rates are tied to the bond market, in particular the 10-year yield. Uh, the Treasury Department of the United States issues bonds. They're called Treasury securities. T-bills, Treasury notes, Treasury bonds, they're all the same exact thing. Just a Treasury bond that is maturing in a very short amount of time is called a note. If it matures in, let's say, 7 to 10 years, I'm sorry, if a Treasury bond is to mature short term, like under a year, we call it a T-bill. Let's say, 5 to 9 years, we call it a note. 10 years and up, we call it a bond. It's just the difference between bills, notes, and bonds and treasuries. It's just so we get an idea of how to classify bonds in terms of, are they maturing in the near term, the intermediate term, or in the long term. But if if you and I and all of our friends are running big funds that buy bonds and sell bonds, if we don't like the way the economy is going, or if inflation's going up and the economy is getting too strong, we are going to want higher yields. So therefore, we could sell the existing bonds we have until the yields go up. So let's say if a bond at 100 cents in the dollar pays 10%, okay? And now all of a sudden, new bonds that come out at 100 cents in the dollar are paying 20%. Well, no one's going to want to buy your bonds only paying 10%. So they have to go down to like $90 instead of $100 per bond, so that interest rate will be higher. It's just the way the math works. So bond prices have a way of, they level out to whatever the prevailing interest rates are. That's controlled by investors. The only time I've seen in my 36-year career when the Federal Reserve has had control over long-term rates, mortgage rates, long-term rates, was after the Great Recession. The Fed entered into, I think, 3 rounds of what's called quantitative easing, when the Fed would actually go into the market and just buy bonds. And they'd buy so many bonds that the demand would go up, and they were the biggest buyer around for bonds. As the demand went up, the interest rates went down. That's how the Fed was able to get people into mortgages at like 3%, 3.5%. That was a very unique circumstance, and a lot of investors really consider that market manipulation. The market on its own natural forces is what should determine interest rates, not the Federal Reserve, not some agency. The president, whoever it is, does not have control over the decisions at the Fed. The Fed decides if inflation's running hot, the Fed will raise rates. If inflation is cooling, the Fed could cut rates. The Fed typically does not get involved in long-term rates, like doing things like quantitative easing, but it was such a unique circumstance with the Great Recession. Um, and it's in large part the reason why we had such a spike in inflation about 2 years ago, because interest rates were too low for too long, and it allowed the economy to get too hot and heat up. It created bubbles in things like real estate. Let's back off from that. We don't know yet if real estate's in a bubble, but it certainly caused higher prices for real estate. But the real estate, funny things, hasn't come down yet, even though interest rates have gone up. When you see mortgage rates are currently about 7%. They were 3%, yet people said if interest rates go up, houses go down. Well, houses went up regardless of how much interest rates went up, and they went up a lot. So the Fed is supposed to be independent. It's not supposed to be, serve at the whim or at the pleasure of the president. The Fed's supposed to be independent. It's not supposed to serve at the whim or the pleasure of the president. And that's an important distinction between our central bank and other countries. One of the reasons why we have the dollar as the world reserve currency is because we have technocrats, professionals who will look at economic cycles, and they realize that economic cycles don't run in neat 4-year time frames to help presidents get elected or reelected. What the Fed does is they understand their mission transcends presidential politics. They realize that bull markets and bear markets, economic expansions and recessions, these overlap presidential terms. It's not the Fed's job to cater to the president, so that the president could do his or her level best to control rates and keep the economy going to stay in power. Remember, economics is the driver of politics. So, what could the president do? Well, the president could appoint a Fed governor, the person who makes the ultimate decision on what the Fed does with interest rates, and that he could appoint somebody who will do what he's told. Trump could appoint somebody, and that person might have to do what Trump tells him to do. And I'm sure they'll agree on that before the nomination, before the president nominates them, because the president is the one who nominates the head of the Federal Reserve. All right. The president nominates Fed governors. So the president could nominate who he thinks are the president could nominate who he thinks are going to cater to his wishes. Or the president could nominate someone whose main concern is the overall U.S. economy, inflation, interest rates, and very long-term cycles. But the president could do that, and that could be an influence. But Jerome Powell is going to be chairman of the Federal Reserve until May of 2026. So we have a year and 4 months to go with Powell. Remember, Powell was originally appointed to the Federal Board of Governors by Obama, but he was appointed as Fed governor, head of the Fed, by Trump, reappointed by Biden. Trump says he would not reappoint him, and he says Trump said in his campaigns that he'll let Powell serve the rest of his term, which is funny because he doesn't really have any power over that. It's like the president doesn't get to halt a Fed governor's term. So I'm going to let you do something that I can't stop you from doing anyway. So there's really no permission structure, although it sounds like there is a permission structure when there in fact isn't. So what else do you need to know? The president doesn't have power over long-term rates. They could influence long-term rates by having better fiscal policy. So if the U.S. government tries to be more fiscally responsible, do something so that the U.S. government could either collect more revenue in taxes or spend less in expenditures, those are the kinds of things that could bring long-term rates down. Or the president could try to push policies like deregulation and things to speed up the economy, so that if we speed up the economy, more jobs, more people paying taxes, more people paying payroll taxes, income taxes, and that would be a positive also in terms of helping with the financial long-term financial health of the United States balance sheet. So that's one way to go. But if you do that, raise taxes or slow government spending, both of those would be expected to slow the economy down. That's not something that a president wants, especially if you want power. You can't say no to people. You have to say yes. You have to keep the economy going strong. You can't cut government spending by much or increase taxes because either way you're going to make half the country miserable one way or another. So the president doesn't really have any influence over the long-term rate. So when he says he's going to, he said it to Davos via video conference to the bigwig conference of financial bigwigs all over the world. He said, "I'm going to demand that interest rates in the United States go lower." Okay, you could demand it, but nobody's listening. You can't force people like me and other investors to buy bonds to push long-term yields down. You can't force the Fed to raise lower interest rates. Other countries like Turkey have tried it and they failed miserably at it. And if investors see that politicians are trying to influence the Fed for their own financial or their own political power, that would be, to me, perceived as a huge, 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 huge negative for interest rates for the economy. Interest rates would skyrocket. It would hurt the value of the dollar because the underpinning of the dollar would be hurt. We have an independent Fed. So the bottom line is, could the president could the president control interest rates, raising or lowering them? He has power to influence by picking the right Fed governors. Powell, the head of the Fed, chairman of the Federal Reserve. Trump is going to appoint somebody new in a year and a half, and he might appoint someone who's just going to say, whatever you want, I'm going to do. I don't think that'll be good for the market. I don't think it'll be good for the economy, and I don't think it'll be good for anybody. But he could do that. He has even less ability to influence long-term rates, which are the ones that you and I worry about, like mortgage rates, consumer loans, automobile loans, that sort of thing. Those rates are set by investors, not by the Federal Reserve. So the Fed cuts rates. A lot of people think, if the Fed cut rates, mortgage rates should go down. No. If the Fed cuts rates, it doesn't really have anything to do with long-term rates. Typically, what happens is the Fed cuts rates when the economy is slowing. When the economy is slowing, long-term rates, mortgage rates, bond yields, they go lower. So if we do have a slowing economy, you'll see long-term rates go lower. If the economy doesn't slow down or if inflation doesn't come in a little bit more, you'll see interest rates stay where they are now or probably go a little bit higher. But that has nothing to do with the president. The president doesn't have power over long-term rates. The best I think Trump or any president could do is appoint a lackey who will do what the president tells him to do. I don't think that's a good situation. I don't think markets will respond well to it. And I don't think it'll make your life easier. And it's certainly not going to bring the cost of anything down. Typically, what brings interest rates lower and costs down are recessions. But that's the very thing that everybody's trying to avoid. And that's my story. I'm sticking with it. If you found this interesting, let me know in the comments. Give me a thumbs up. Share this with your friends. And thanks again. I'll speak to you tomorrow. Have a good night.